Good morning, and thank you for joining the Challenger Gold Investor Webinar. I'm Jane Morgan, the Investor and Media Relations Manager, and today I'm joined by Challenger's Managing Director, Chris Canal, who'll be providing a company update and engaging in a Q&A session. So to ask a question throughout today's webinar, please use the Q&A function, which can be found at the bottom of your screen. Chris, I'll pass to you.
Thanks, Jane, and everyone who's online, thank you for joining. I'm going to focus mainly today on the scoping study and then give you a bit of an update as where to from here. So just work through the cautionary statements. So look, Challenger, most people know who we are. Two assets, both in South America, 4.5 million ounces in Ecuador, which is on the back burner at the moment due to market conditions. Lead asset, very much our Hualilan gold project in Argentina, in San Juan. Just finished a robust scoping study, positions us as a top 20 ASX gold producer with lowest quartile cash costs. The study, look, it's an outstanding result and it's an outstanding asset. And how do I know that? And I'll talk to this later. Within a week of putting out the study, we were approached by various groups wanting to talk to us about non-dilutory funding, potential strategic investments, and we're running a process now. So, what does the study look like? Puts us in the top 20 of ASX listed producers. Yes, it was a scoping study, but really it was a pre-feas dressed up as a scoping study because we've still got some work to do on picking the final process route and also the actual mine plan. But it was done to a plus or minus 15% accuracy, where most studies are done to plus or minus 25%. But you've got to put a line in the sand. San Juan itself, great place to build a mine, still voted #1 mining jurisdiction in South America. And most importantly, we're having this work done now, opportunity to become one of the lowest carbon intensity gold mines in the world. Financial metrics, compelling. Life of mine EBITDA of 1.1 billion dollars Aussie. That's all at 1750 gold. Rapid payback period, just over a year, which is really important in this current climate. Pre-tax NPV, 800 million dollars at current spot prices. Really quick, high IRR as well. Again, to go into it in a bit more detail, average production of 116,000 ounces of gold, 440,000 ounces of silver and zinc. All up, it's about 140,000 ounces gold equivalent. All-in sustaining cash cost of $830 US, which is world lowest cost quartile, and actual C1 cash cost of $527 US. You'll hear this a lot during the presentation, low risk. It's got a low-risk starter pit followed by conventional underground mining with 3 working areas, which offers flexibility. Geological risk is really low. We've done 220,000 metres of drilling. The entire ore body is drilled out on 40 by 40 metre spacing at worst. 81% of this scoping study mine plan is indicated resource. So we're not going to get any nasty surprises from the ore body. And when we do start processing, we've got half a year worth of material sitting on the ROM pad as well. So we've got 6-month buffer, and that continues throughout the mine. Importantly, and I'll talk to why the study was targeted this way in the next slide, there's sort of 4 or 5 clear opportunities where we can add significant value. Firstly, we focused on the high-grade core because of the market conditions. There's another 1.7 million ounces left at the end of the scoping study mine plan that we're doing the work now. We think we can get a fair chunk of that out. We cut the ore body off for the purposes of recovering the zinc at a 1.5% zinc grade. We've now done some work down to 0.4% zinc, and we can recover the zinc economically. We double up the zinc we recover in the mine plan. It adds more than $100 million to the value. We're producing a gold and silver concentrate. The cost of actually getting that concentrate to site or from site to a smelter is about $150 a tonne. The cost of processing it is that much again, plus payability. If we can produce gold doré on site, we add about 150 million US to the value potentially, and we're doing that work now. You'll hear about that work in the next month or two. All the work on the mine plan was done at $1,700 gold, and you've got to draw a line in the sand somewhere. And subsequent to doing all this optimization, mining costs are 10 to 20% lower. So we'll redo that optimization at $1,750 gold, and there'll be material upside there. We'll get probably at least 100,000, likely 200,000 ounces additional in the mine plan if nothing else changes. And not to mention the mineralization's open everywhere. And I suppose, look, how did we target the study? the study focused exclusively on this high-grade core, and we did that for a reason. And I'll talk to the state of the market right now. So what I'm showing you here is a chart of all of the South American developers, ASX listed, that have got resources. And you can see there, it's not pretty. Every single one is down, almost 60 to 90%. We've taken here just the Australian gold developers and explorers, starting with A, similar thing. Only one company is not down more than 50%, and that's down 37%. It's a terrible market to be a gold developer. And if we had to come out with a study that admittedly probably would have produced 500,000 ounces more gold and had a bigger value, but had a $300 million capital expenditure, we never would have had it funded. We just wouldn't have had a credible path to production. Whereas I know we do now, because we've got some groups in the data room that are going to offer us that credible path to get into production, if not before the end of the year, early in the first quarter, so that then the market will, I think, know that the certainty of funding, and then can look at the upside attached to the project. Just the highlights of the project, or the scoping study, really robust project. It will be Argentina's next mine. This is where it positions us. So what I'm showing you here is the current ASX producers and their annual production, also the near-term producers like De Grey and Bellevue Gold, puts us just inside the top 20 of ASX gold producers. This is cash cost of the current ASX producers and near-term producers. Again, it's got companies like Bellevue and De Grey in there. We're the fourth lowest cash cost producer on the ASX once we're up and running. And then total capital expenditure, you can see in that table there, 150 million US. There's $15 million contingency in there. So hopefully it's 135 million. And that CapEx puts us at the lower end of capital intensity per ounce. And a project with $150 million CapEx with the 1.25 year payback, that's eminently financeable. With that short payback, we've got the ability to go to some of the US specialist mining lenders. If we've got to take 12, 13, 14% debt, it doesn't matter if we can pay that back in 1.25 years. And so that is how we get into production. Just on the scoping study mine plan itself, again, that word low risk. So it's a vanilla starter pit with 1 million tons of high grade, 1 million tons at better than 4 grams gold sitting at surface. It's a single pushback pit. And then we roll into underground. The 3 underground areas, we decouple the entrance from the bottom of the pit. It doesn't really save us much development meters to take it out of the pit, and it lets us start early. It's vanilla underground mining. It's got 100% paste backfill, which lets us get 95% of the ore out. Each one of those 3 areas, if we have a problem, can be pushed up to 500,000 or 600,000 tonne per annum. It's also got the ability that, depending on adding reserves, you can push that underground production up from the 1 million tonnes we've budgeted onto 1.5, perhaps more. So again, low risk, lots of upside. There's a crown pillar in there. We haven't factored in moving equipment between the mines. We lock the equipment in the mines. There'll be another cost saving there and probably some productivity gains. That's all being worked on now, and that'll come out in likely a scoping study update at the end of the first quarter, start of the second quarter, and then we'll roll straight into a pre-feasibility study. This is basically our production schedule. So the purple there is the high-grade gold and zinc ore. The yellow is the high-grade gold ore. The green is the lower-grade material. And what you can see there is, in year 0, which is when we're building the plant, we've mined 500,000 tonnes. That sits on the ROM pad ready to be processed. And then production is fairly steady at over 1 million tonne per annum until we finish the mine life. Now, that mine life won't end at year 7. Deposits open in all directions. We've got holes at the bottom of stopes underground where we've got 25 metres at 5 that we haven't drilled. Right now in this market, we'll get no upside, but it won't be a 7-year mine life. And the reason we've gone with a 7-year mine life is if you run it out any longer than 8 years, you've basically got to replace all the equipment. So 7 years, 8 years is what you want to target at the moment. And this is the process plan. And again, that word vanilla, it's pretty simple. It's off-the-shelf technology. We crush the ore. 40% of the gold comes out in the gravity circuit. Then, depending on the type of ore, it's a pretty simple flotation exercise. We produce a gold silver concentrate and a zinc concentrate. as I said, we'll try and convert that zinc concentrate, or that gold silver concentrate, to doré on site, which will be a $150 million win for us. And the plant is basically set up so that it can process the different types of ore. We just turn a switch and you bypass certain parts of the circuit. This is our forecast production schedule. So you can see with that 500,000 tonnes we get out before we start processing, it gives us an opportunity, if we get the plant finished, to start production earlier. It also lets us put, the best and high-grade material through. We actually get 150,000 ounces of gold out in the first year, almost 200,000 ounces of gold equivalent. And then production's fairly steady at around about 16,000 ounces of gold, 140,000 ounces gold equivalent. This is just the cumulative cash flow. So, and again, at $1,750 gold, it produces 527 million US pre-tax cash flow. At current spot prices, it throws off, over $1 billion of pre-tax cash flow over the life of mine. And then, the upside, and this is the important thing. What you'll see over the next couple of months is a series of ASX announcements addressing this upside before we pick our final path and update the study and then go down the pre-feas. So, upside one, recovery of that additional 1.7 million ounces. Now, we've started to do some preliminary work. A much larger pit does work. We're doing the work now. We'll partner up with one of the open pit equipment suppliers, and they'll do a lot of that cost work for us. We use $2.50 a tonne, increasing 40 cents a tonne every 100 metres, which is quite conservative. Other big open pit mines in Argentina are mining at around $2 a tonne. We get our mining costs down around $2 a tonne, and this will be a big open pit. We'll still start with an underground component to make sure we can stage it and get the high-grade material. One of the key planks to that big pit is we're nearing the back end of a process to evaluate if heap leach works. The preliminary results, look really encouraging. They're 90-day tests. We're at day 85 now, so we're about to start washing those. Expect some news on that, before Christmas. Low-grade zinc concentrate I've spoken to. We currently recover 60,000 tonnes of zinc in the scoping study. If we can double that, and you will if you can lower that cutoff grade, then that's worth $120 million in revenue after all the costs. Again, that improvement in underground optimization. We ran that underground cutoff at almost 2.5 grams a tonne. The real cutoff grade we need to use is 1.9 now that we've tidied up the costs. That should add at least 200,000 ounces into the mine plan. And then we ran a thing called Sudaflow, which took another 70,000 ounces out, which likely goes back in as well. I've mentioned the production of gold bars on site. That could be a huge saving for us. That's worth 150 million US. And then I've spoken to the reduction in open pit mining costs. And, look, this is, I suppose, shows this is the resource here. You can see the red and pink are high grade. This scoping study was focused on this yellow here, the 8 million tonnes at 5.5 grams gold. And if you look up to the actual resource, we've left more than half of the resource on the table, and we're now going back and doing that work. Treat this scoping study as a base case, and there'll be significant upside that will come from this study as well. This is what we're working on now in terms of, some of the upside. So the scoping study case is in the dark brown or the red. You can see there 3 small open pits and then the underground workings. The blue there is some recent, larger open pit work we've done showing what a big open pit will look like. The encouraging thing out of that is still a fair chunk of underground material. It gives us the ability to start with that high grade from the pit, also go underground so that we keep that 1 million tonnes of high grade feed going, and then backfill with lower grade material around it. But certainly, we'll produce a much larger pit. We'll get much more of the gold out, and that will increase the value of the study, which is already significant. This is just showing the Sudaflow analysis. So when you optimize an underground mine, normally you look at a cutoff grade, and any stope above that cutoff grade you mine. What we've done is we've taken into account the development meters. So how far you've got to sort of dig a tunnel in order to get there to mine that. And what that done is everything there that's sort of yellow or orange has been taken out of the mine plan. The costs we used in that analysis, we used, $4,000 a metre for the decline, where our real cost is much lower. Same thing on your development meters. So a lot of that 72,000 ounces goes back into the mine plan when we redo this at a higher gold price. And again, that will get at least a couple of 100,000 ounces all up into the mine plan, which every 100,000 ounces is likely to add 50 million US to the project's value. This is just some of the cost work we've done. I won't talk to it. All I say is, look, all of these mining costs, processing costs were all done by external independent experts, all done from bottom-up principles using the mine design, Argentinian costs, imported costs. There's not a lot of risk you're going to see these costs blow out as we move forward to the next stage. And same thing on the processing costs. Not much risk attached to those increasing, and hopefully we can bring those down with slightly larger plan. The exploration upside, again, we're now working up these targets. We've expanded our surface geochemistry program, given some of the anomalies that we're building up. But there's going to be 3 or 4 really interesting looking targets to drill sometime next year once we've got some funding done. It's not dilutionary, but while it are still open everywhere, it will be a much larger mine. But we're sensible. We're not going to go drilling right now because I don't think there's much value in this market. Although it does look like I think we're getting to the turning point of the market now. There's a little bit more interest and the market feels better. So look, next steps, where to from here? So look, right now we've got a value of 110 million, scoping studies, 600 million. In a better market, normally you trade at 50% of that scoping study value. We should be trading at 3 times the current price. We've got upside attached to the ounces not in the study. Not to mention Ecuador. We're sort of working on something to split Ecuador out of the company now. So you'll see Ecuador actually realise some value for us and for shareholders. But in terms of next steps, as I said, I know the scoping study was a great outcome, despite the reaction we got in the market, which was all about funding. As we've gone around and seen some of the funds, the question is, okay, you get 7 in the bank. Yes, that gets you through until June next year. But to finish a bankable is going to cost you 15 million, maybe $20 million worst case. How do you fund it? As I said, we've been approached by a couple of Australian-based mining funds that are in the data room now. We've been approached by a strategic from overseas that's finishing up in the data room now. We've had a couple of royalty companies express interest. We haven't hit the button on that. That's something we'll do in January, depending on where we get to with these other sort of outcomes. But, look, in terms of how to from here, the company, we're not that interested in doing a deeply discounted placement, anytime next year. We'll get something done that involves something non-dilutionary or a strategic investor. And I think that's when we start to be re-rated. Right now the market's concerned about how do we fund it? And I think we'll have that answer. Certainly by the end of the first quarter, we'll have that answer for the market. In the meantime, we should get, hopefully next week, the results of this testing to tell us how viable heap leach is. As I said, the results look good, but now what we've got to do is wash out those columns, actually assay the residue and see if the recovery is actually what the preliminary results are telling us. Some additional flotation test work has started to see, if we can actually better refine that low-grade zinc pathway, which is a big value uplift. We're doing the testing now on, can we produce a doré on site? We should have some news there during January. And if that looks encouraging, then that's a big tick for the project. Helps your cash flow, makes the project much more, makes the project, adds $150 million to the value. We're doing some work now to just rule out whether it is a CEL or flotation. They're line ball at the moment. We've got a simple flotation pathway. We'll just do some more testing now to rule out CEL. What we want to see is that the flotation case is, $50 to $100 million more valuable than the CEL case before we rule out CEL. We'll update all of our cost models and then run the sort of bigger pit case. And, you'll see this news come out progressively over the next 2 to 3 months. Then, we'll update the scoping study, and that will be the version we'll run through with the pre-fees, target to get the pre-fees done by the middle of next year. Thanks, Jane, and sort of happy to take any questions.
So how does Argentina's inflation affect project development in terms of CapEx and other costs?
Yeah, so look, first thing is, people might not be aware there was an election for a new president 2 weeks ago. There's been a change in government. The new president is from the far right. He's very progressive. One of his key planks is to open Argentina up for business. The challenge with inflation in Argentina had been, massive social welfare, and they run sort of 2 and 3 different currencies, very complex. And his plank is basically one exchange rate. He'll let the market decide what the exchange rate is. The government won't try to control it. And what you'll find is, look, Argentina may have a difficult first 6 months, but I'd say by the time we get into his second year of presidency, it will be a much lower inflation environment. It will be a much simpler place to do business. You might see some more favourable terms for miners. For example, our scoping study factors in an 8% export tax on gold. Now, that 8% export tax is a temporary tax brought in by presidential decree. If that was to go again, we're probably 150 million better off in terms of value, and it wipes about $150 off our all-in sustaining cash cost. So, look, we've managed to get our drilling done. We've managed to get our work done. They've been dealing with inflation for years, but I think this change in government is really encouraging. It will make putting a mine into production much, much easier. And also you'll see a lot more interest from, foreign mining companies on getting into Argentina now. And we're already starting to see that.
Wonderful. So next one, and you touched on this in the presentation, but when do we expect to release the updated data based on the US $1,750 per ounce gold spot price and the lower mining costs?
Yeah, so look, as I said, you'll see progressive news over that. The aim is to get, something out every, 3 to 4 weeks. First will be the results of the column testing to give us an idea of the heap leach case, and that'll add significant value. Then, January, you'll see the results of the testing. Can we produce doré on site? If we can, adds $150 million value. If we can't, well, we've already got the value. Then we'll re-optimize, post doing a little bit more cost work for the higher gold price. We're still working out, do we use $1,750, not $1,700, or do we use $1,800? We'll put the results of that out, and then that'll see an updated scoping study, probably sometime in March, and then roll straight into a pre-feasibility study. And by that time, you'll have certainty of funding for one of these non-dilutionary options or a strategic. And I think, the market will respond well to that. There's a couple of companies recently that have announced these non-dilutionary transactions, and they're all up 30 or 40%.
Thank you, Chris. And again, you touched on this question in the presentation, but what are the financing options for the project? Will you seek to bring on a strategic partner, or is it possible to pre-sell some of the gold to assist with the financing?
So look, all of those options are possible. So as I said, we're talking to a couple of strategics now. We've had a data room open for about 10 days. We've got both strategic investors and mining companies in there. We've also got not royalty, they're more project finance groups that will do early stage debt funding that then either rolls into a royalty or wraps up into a larger project finance facility. So yes, that's an option. We haven't gone the wider royalty route yet because we don't think we'll need to. We think if we can get something done that involves an overall project finance facility or a strategic, that the market will take that much better. If you sell a royalty now, look, it's non-dilutionary, but you probably get half the price for the royalty that you would get if you're selling that as part of a package to, actually finance your mine. But yeah, look, all of those options are available, and we're down the path with 2 of those, and we've got the royalty option as plan C, and a equity raising sometime, late first half, early second half of next year is very much a plan D, E, or F.
Thank you, Chris. And so can you please outline the exploration strategy for 2024 to extend the life of mine beyond the initial 7 years?
Yeah, so look, and again, this will be post getting one of these funding options done. It's non-dilutionary. We've extended our sort of soil and rock chip sampling, looking for anomalies outside of the mine area. It's produced some nice ones. They're still growing south, they're still growing north. So what you'll see is we'll put all of that together over the next 2 to 3 months, generate, it'll be at least 3, hopefully it's 4 or 5 really nice drilling targets. And then again, we'll look to do some of that drilling once we've actually, got this non-dilutionary funding through. We won't do too much drilling. We've got to focus on getting into production. In terms of extending the mine life, 7 years mine life, and that'll probably roll out to at least 9 or 10 years when we update the study. It is plenty. In terms of if we go and drill holes now, yes, look, we'll add 300,000-400,000 ounces easily to the resource at depth. It'll be high grade. But I think the difference between 2.8 million ounces and 3.2 million ounces, the market's not going to care. That's far better left until we're in production. We've got the declines deeper and we're drilling them from underground where it's far more cheaper. I mean, look, 7-year mine life is plenty, and, that'll be just the start. But, I think the value we'll get for finding new areas is, far greater than actually adding, 400,000-500,000 ounces to the current resource now.
Wonderful. Thank you, Chris. And I mean, it's no surprise that the gold price has been reaching all-time highs, and there's significant potential for the spot price to increase much further than this as well. So if this occurs, would you restate the study in the future based on that higher gold price?
Look, we will, but, I think at the moment, we'll probably stick to the same $1,750 gold price in the study. I think, most institutions, most brokers, have their own gold price forecast they use anyway. I think if we were to turn around now and update the study tomorrow based on $2,000 gold, we look a bit silly. So look, it will either be $1,750 or $1,800 when we update it, and I think we'll sound out a few of the market participants first, just to make sure that they're comfortable with the price we're using. I think, what price we use, the market will factor in the price it wants to use anyway and value us accordingly.
Thank you. Jumping around a bit here. So do you still plan to do an updated MRE in Ecuador this month?
We are working on that now, yes, and it will be done. It's not so much an update. It will be an update, but it'll be done to Canadian standards, 43101 standards, which probably gives a hint of what we're leaning to do with Ecuador.
Thank you, Chris. Again, jumping around, but when are we targeting first production?
Look, realistically, the timeline from here is finish the pre-fees middle of next year, 1 year to finish your bankable, and then you've got 6 months to close your financing, 12-month construction. So you're looking mid-2025, mid-26, late 2026. And, if I tell you we can do it sooner, then I'm not telling the truth.
Well, just further to that, then the next question. So when are we expecting to deliver the pre-fees study?
Yeah, so the aim is to deliver that, in the middle of next year. So June, July next year.
All right, next one. So what are the potential risks in bringing the mine into production on time and within budget?
Look, I think we've seen that, most mines are blowing out their capital costs at the moment. Hopefully by the time, we're sort of 3 years out, inflation is under control. I think it's also a case of, building a decent buffer. I mean, let's assume we can almost 100% project finance the mine because of the quick payback with the combination of debt, project finance and royalty. Quite frankly, what we do once we've done all that and, we're at a much higher price, is we'd go out and raise equity to cover us as a buffer anyway. Look, it's all about doing the cost work, probably doing it externally so that you're not trying to bring it in at a cost. The cost is what the cost is, and make sure that work's done properly. And you've gone out and got, vendor quotations. And you should see some partnerships with, underground and open pit equipment vendors, sometime in the first quarter, which will take a lot of risk out of that. We're talking with them about things like, vendor managed inventory, which takes all of the replacement parts off our books. They'll provide those. It takes potentially maintenance off our books, and the equipment vendor provides that as well. So we're looking at sort of some novel things like that will hopefully reduce our headcount and lower our costs and give us de-risk a lot of those costs.
Thank you, Chris. And I think just finally, so you did mention this and there is a slide in the deck, but just to reiterate to the webinar attendees, what should they be looking forward to from a news flow perspective over the next 3 to 6 months? Yeah,
so look, from a news flow perspective, you'll see, does the metallurgy likely to support, that heap leach case, which should lead to a much larger pit and a bigger NPV? Can we recover more of this zinc with a lower grade, which again, adds to the value of the project, doubles the amount of zinc we produce. Can we produce concentrate on site from gold and silver doré, which again adds $100 million to the project value? If none of that works, we've still got a great project that companies are interested in right now. You'll see some partnerships with equipment vendors. You'll see a strategic or a non-dilutionary finance done sometime next quarter. So and then you'll see an updated study, and hopefully by then in a better market, we're not trading at 25-30 cents in the dollar, like not just us, but most gold stocks are that aren't in production.
Wonderful. Well, Chris, that's all we have time for today. Thank you all for joining us for the Challenger Gold Investor Webinar. If we've missed any of your questions, please feel free to reach out via the contact details on the bottom of our ASX releases. But thank you all for your time.
Thanks, Jane, and thank you, everyone. And again, reach out to me if there's any questions via email.